And it's January the 26th, 2023, right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning Live on Channels Television. I'm Ladi Williams. Let's take a look at what's happening now. It's 5 days to the January 31st deadline set by the Central Bank of Nigeria to stop the old 1,500 and 200 naira notes from being legal tender. And obviously everyone has the experience of either getting the new notes or not able to swap for the old ones. And we obviously we have people that also have, you know, the new notes. I'm still waiting to get mine. And you can send us your experiences with the new naira to our email, businessmorning@channelstv.com. Let's know how it's faring for you if you're able to get the new notes. But the deadline, 5 days to go, and we'll see what happens next. Well, let's take a look at what's happening with oil now. We see Brent crude futures dipped 4 cents to $86.08 a barrel in early trade, while US WTI crude futures, that rose 18 cents to $80.03 a barrel. Obviously, we still have volatility in that market. I'll be drilling down on what's driving sentiment later on the show. To global grains market now, U.S. wheat futures rose with soaring prices for supplies in India, boosting prospects for increased demand for U.S. exports. The CBOT March soybean futures, that was up about to $14.95 a bushel, while corn, the delivery for March, that was up about $6.77 for half a bushel. We'll also drill down on what's driving sentiment in that market. And obviously back to the new naira again, with less than a week to the January 31st deadline for the phasing out of the old higher denomination of the naira. The Central Bank of Nigeria has taken its sensitization campaign for the redesigned currency notes to traditional rulers and stakeholders in Ekpe. The exercise saw CBN monitoring teams paying courtesy visits to the paramount ruler of Ekpe land, Kamaruddin Animashao. CBN team also visited the Oluwo Modern Fish Market at Ekpe, where it urged the traders to deposit their old notes before January 31st, as the deadline remains unchanged. Take a listen.
We accept the new currency by the CBN from the federal government. But what we are agitating for is that to make sure that the money is available to all banks, so our people can get it through the banks. And then that you have made it available for the POS, we thank you for that. Most especially the ATM, and then considering some of the big business organizations. Our agitating is that the money has to be available in all banks. And you have to implore banks to pay this money, new note, to everybody.
1,500 and 200 naira notes. And we have brought the message of the governor of the Central Bank of Nigeria to all nook and crannies, especially the riverine area, to the people of Ekpe, to say, please, bring out your old 1,500 and 200 naira notes. As we speak, it is still a legal tender, yes. But come January 31, there will be no extension. And so we are pleading with our market women, our fishermen. That is why we have come to the riverine area ourselves, to preach the same message, to let them know that January 31 is just few days from now. They can take their existing 1,500 and 200 naira notes to any bank around them, and of course get the new notes.
Yeah, deadline so close at this time, and obviously there are going to be implications for the economy going forward. But we still got that rate hike earlier this week from the MPC. Let's drill down on how that's impacting the commodities market now. We have joining us Dr. Desola Sumoni, Senior Associate Financial Derivatives Company, join us via Zoom. Great to have you. Good morning.
Good morning, Ladi. Thank you for having me on the show.
Yeah, so Adesola, I know you don't have any problems exchanging your old notes for new ones. You're way over there in the UK, Adesola, so good for you, right?
I mean, I do have some naira notes here in the UK. I mean, just to, you know, just some like maybe 20K or 50K thereabout, but it's not a big deal. I've accepted it as sunk costs. I cannot exchange it, but most of my trade is online. I think yes, the deadline is coming closer a few days from now, and there's still a lot of I think there's going to be a lot of rush to the banks to exchange the old naira to the new naira notes, as the central bank governor said. We're not changing, we're not shifting the deadline. Even though to start with the deadline was short, to be honest. But the central bank has said we're not going to shift it, and there's going to be a lot of rush. There's going to be a lot of commotion in commercial banks in the coming days, but also in the foreign exchange market, with people either buying dollars or trying to exchange their old naira notes.
Well, but there's all of that 50 or 20K that you still have there with you. You need to find a way to get it over here to me. I'm not going to let that go. But let's talk about the recent rate hike there by the MPC. We've had mixed reactions. Trail it is about 17.5% now, and obviously we saw the T-bills rate actually fall. But when you look at, when the U.S., raises rates, we see the U.S. dollar, that always reacts positively to that. We had that massive run, in 2022, but it's not the case with the Naira. Why is that?
In a host of factors, like first of all, the rate hike came as a surprise to most market watchers, and most analysts expected monetary policy parameters to remain unchanged. Or even if they're going to hike, we should have seen maybe a 50%, a 50 basis point hike in benchmark interest rate. But they went all the way to 100 basis points, which came as a surprise to everyone, me included. But I think it's just the central bank trying to signal that they mean business with inflation. That try to signal confidence, or try to signal their commitment to fighting inflation. And this has a host of implications. But let's look at cumulatively in the past 10 months, Ladi, the central bank has increased benchmark interest rate by 600 basis points, which is essentially 6%. But inflation has only declined by 0.13%, which for me suggests that maybe some of the key drivers of inflation are not primarily monetary factors, or there is a breakdown in the transmission of monetary policy from the benchmark interest rate to actually affecting prices. Also, like you mentioned, the T-bills, usually the benchmark interest rate is kind of like a signal, right, for the market that, okay, now we are going to increase a signal, or to anchor expectations, interest rate expectations in the financial market. So with the interest rate at 17.5%, which is, I think, a 15-year or 17-year high, all other interest rates in the market should follow suit. But we are not seeing that, to be honest, Ladi. If you look at, like you mentioned, the Treasury bills rate, we saw a 91-day Treasury bill rate at 2%, 182 Treasury bill stop rate at 4%, and a 1-year Treasury bill note study is 7%. Meanwhile, benchmark interest rate is 17.5%. So we see that big mismatch. We see that it appears that other interest rates in the economy are not trailing the benchmark interest rate. To me, that suggests there's some breakdown in the transmission of monetary policy.
And if we look at inflation in the Eurozone, in the US, we've had that downtrend, with the rates in those countries, and you would wonder, is it the rate hikes that actually bringing those inflation rates down, or is it just energy prices actually going down and food prices in the global market?
A host of factors. So first of all, they are not comparing apples to apples, right? They are comparing apples to oranges, right? So the monetary policy, the transmission essentially of monetary policy in the US, the UK is quite stronger, or is better than in Nigeria, which is a developing country. But like you mentioned, the US has over the past 10 months, they've increased their benchmark interest rate by around 4.25% cumulatively, and inflation rate has responded by declining by around 2.6%, which kind of shows that inflation is responding to the hike in interest rate. But apart from that, we're also seeing some of these bottlenecks that reduce supply, that makes too much money pursue too few goods, according to Econ 101. We see some of those supply bottlenecks ease. We're also seeing energy prices, food prices also ease a little bit, and those factors are contributing to they're contributing to the decline in inflation. But you mentioned something, and at this point, it's quite difficult to to predict the pace of monetary policy, at least in the US. There's so much confusion, and at this moment, it's a mixed bag. Like I mentioned on Tuesday, Ladi, market economists see a smaller pace in interest rates hikes, while the US Fed officials are seeing a higher pace. So there's this mismatch, and it's confusing the market. On one hand, some officials are giving comments, are giving like dovish comments. On the other hand, some other officials are giving hawkish comments. So it's a bit of a mixed bag. But what I'm at the bottom line, Ladi, is that inflation is responding to hikes in monetary policy rates in these developed economies.
All right. How would this the recent hike? How would that impact the domestic commodities market here in Nigeria?
Okay, so one of the immediate impacts of the hike in interest rates is that, first of all, increase the cost of credit, right? So it's more difficult to get money. It's more expensive to borrow money, which kind of limits, which kind of strengthens naira, right? And it limits the amount of, it limits spending in a way, right? So that's kind of has some effect on domestic commodities markets. In the sense that one, the naira strengthens, but that also affects, reduces demand, right, which would kind of ease pressure on the domestic commodities market. But as at now, and for the near term, there's no change because inflation is really sticky, or prices are sticky, right? Meaning that they're quick to rise up, but are very, very slow to come back down. So we are still going to see prices still remain high. You are still going to pay 38,000 naira for a bag of rice, right? You're still going to pay 20K for a bag of 50 kg bag of flour. You're still going to pay 16,000 naira for a 50 kg basket of tomatoes. So prices are still sticky, but hopefully they're going to trend downwards. We expect that they're going to trend downwards. Inflation, headline inflation will trend downwards, but prices are still a little bit sticky.
And obviously, you know, when the rates were hiked in the US, obviously we saw the equities market in 2022 reacted negatively to that. We saw, you know, sell-offs with the tech-heavy NASDAQ, but in Nigeria, you know, the equities, the local bourse, that went up, you know, was best performing fourth globally. But now, with this rate hike we had on Tuesday, we've seen the market decline in two sessions. What's that telling us?
So Econ 101 will tell you that there's a negative relationship basically between interest rates and stock markets. Essentially, when we see hikes in interest rates, typically the stock market closes lower. One key reason is because it, first of all, increase the interest expense cost of companies, which then affects their stock price. And if many companies also have like huge debt, then that knock-on effect of the increase in interest expense pushes down stock prices. So that's part of why I think we are seeing this negative effect. But in addition to all of this, we are forgetting to say that this hike in interest rate came at a very, very unusual time. Like it is very, very unusual and unorthodox to hike a benchmark interest rate so close to an election. Like if I just 30 days to an election, there's so much uncertainty. It's so difficult to anchor expectations in an environment of political uncertainty. So I think that is part of why, you know, there's such strong reactions to the recent hike in benchmark interest rates.
Yeah, so many reactions at this time. But all right, let's look at what's happening in the oil market now. We see prices still quite away from that $100 mark, even though we've had projections that $100 is going to happen again, you know, this year. What's happening in that market?
No, like prices got as high as $89 per barrel this week. I mean, obviously, part of the reason is optimism about China's reopening, but prices, oil prices have been volatile this week, mainly driven by two key factors. On the baseline, we have this optimism about reopening of China, which was positive for prices. But in the US, we are seeing two different factors driving sentiment in the oil price in the United States. On one hand, we saw a smaller than expected buildup in US crude stock inventories, which kind of signals that some tightness in this market supply. Data from Energy Information Administration from the US showed that crude stock inventories for last week increased by 500,000 barrels last week, as against expectations of an increase to about a million. A million barrels last week. So this shows that this signals some tightness. So that was supportive of prices. But on the other hand, some data coming out of the US, especially business activity, raised concerns. So data from US business activity showed a contraction in business activity in the US, which kind of raised concerns about a slowdown in economic activity and an economic a meltdown, which has implications for oil demand in the US. So those are the two factors at the moment driving oil prices. And beneath all of that is some optimism about the reopening of China.
And obviously the same sentiment will still be driving, what's happening in those markets with prices, next week. What are you expecting for oil prices and LNG prices next week?
Talking about oil, for oil prices next week, the biggest factor that will affect it is the US interest rate, right? So like I said, there's mixed reactions, there's mixed expectations about US interest rate, the pace of increase in US interest rate. Some analysts are forecasting 25 basis points, others are forecasting a 50 basis points. It's very difficult to know which particular direction the US Fed is going to go. So that is going to be a big factor that would affect oil prices next week. Talking about LNG, the biggest factor is the weather at the moment. So initially, there was fears that in Europe in particular, there were fears that because of Europe trying to wean itself from depending on Russia, that there was going to be issues around about rationing energy in Europe, as well as blackouts. But because we had a warmer than expected winter early on in December, that increased. First of all, that reduced demand for natural gas. It also increased the storage of natural gas. So at this time of the year, the amount of natural gas in storage is around 78% higher than what should be available around this time of the year. That was due to warmer than expected weather. Also, we are seeing huge imports coming from the US, coming from Canada, as well as the Middle East. So all of these factors are driving LNG prices. So next week, there's forecast that this cold snap we are seeing in Europe now would ease next week, even up until mid-February. And that is kind of like reducing the demand for LNG, together with huge storage and huge imports. That is why we are seeing the LNG prices are trend downwards at this time.
And obviously, investors globally looking out for that Fed meeting and how hard they're going to go with rate hikes for that meeting for 31st into February. But now let's look at cocoa production in Nigeria. It seems that's getting a boost.
Yeah, I mean, early rains coming out of the Harmattan season. Early rains has been supportive for cocoa production in Nigeria, but globally, we are seeing cocoa prices on delay due to conflicting or different drivers coming out of Africa. We know that Africa, West Africa in particular, have some of the biggest cocoa producers. So coming out of Ghana, for example, we are seeing concerns about supply because of the outbreak of swollen shoot or swollen shoot virus in many of the cocoa growing regions. So that's raising concerns about output coming out of Ghana. But on the other hand, in Cameroon, in Ivory Coast, in Nigeria, we are seeing positive news about rains, positive news about larger than expected harvests are coming out of this country. So these two factors, while the decline in output or the expectations of a decline in output from Ghana is kind of raising cocoa prices, good news coming out of Ivory Coast, coming out of Cameroon, coming out of Nigeria is kind of capping the price increase. So those are the two factors driving cocoa prices at this time, Ladi.
And what about the domestic commodities market here?
Okay, for the domestic commodities, it's mostly good news in January because January is, dry January, right? Many people have spent a lot of their money in December, so January is kind of quiet.
It seems January wasn't that long.
Tell me about it. Because of there's so much activity. I mean, I can never believe that, next week is the end of January. Anyway, because of there's lower demand in January, plus effect of the harvest season, and the naira kind of strengthened over December coming into January. So we are seeing prices generally trend downwards. As a matter of fact, the price of a 50 kg bag of rice is down 13% to 38,000. 50 kg bag of flour is down 70% to 20,000 naira. A basket of tomatoes is down 38% to 16,000 naira. Peppers is also down around 48% to 25,000 naira. So generally, we are seeing prices trend down, which is positive. But they are mainly driven by three big factors. Like one is lower demand because of in January, typically January is associated with lower demand. Two is there's big supply. First of all, many of these commodities were stocked up for the festivities, so there's still kind of like an excess supply of those. And three is the naira has strengthened over the holidays are coming into January, so that has also affected the import cost of some of these import-sensitive commodities like flour. And finally, we've seen the effect also of the harvest season. So those are the factors that are driving commodities market at this moment, Lad.
All right, thank you so much, Dr. Adesola Simoni, Senior Associate, Financial Derivatives Company. Thank you.
Thank you for having me.
All right, so after the break, we get a sense of what to expect as the National Bureau of Statistics releases the capital importation report, expecting that tomorrow. That's for the third quarter of 2022. That's our next conversation. Just stay with us. Welcome back now to our next conversation. Nigeria Capital Importation Report for the second quarter of 2022 showed that the inflow to the production sector recorded the highest growth in the first half of 2022, with the banking and financing sectors trailing behind, while inflow to shares took a downward turn. Let's get a sense of what to expect for the third quarter 2022 Capital Importation Report. Join us now is Segun Adams, research analyst at Afrinvest Research. Join us via Zoom. Great to have you on the show.
Thanks for having me, Ladi. Good morning to you.
Good morning. So as we prepare for that report tomorrow, that's for Q3, what are your expectations?
In providing our expectations, I would just like to quickly provide a bit of context or perspective. So the capital importation report published by the NBS, the quarterly report, which tracks cross-border capital flows, whether in the form of foreign portfolio investments. They talk about investments in equity, money market bonds, type financial instruments, or you talk about the more patient long-term capital foreign direct investment, which can also take the form of physical capital importation as well. And then you have the other capital such as loan or trade credit and so on. And why this report is important is for two reasons primarily. First is that capital importation is important for any country to bridge their savings investment gap. By that, what we mean is that every country has a level of savings that they target to be able to engender growth or accelerate growth. And it can be the case sometimes that the savings you can mobilize domestically is not sufficient to meet that mark. So you have to rely on capital from outside your economy. And secondly, that report is also a form of litmus test to see what the perception of foreign investors towards the Nigerian economy is. And so far, what we've seen is that since the outbreak of COVID in 2020, capital importation into Nigeria has been somewhat, it has been waning and it has been not very impressive. For instance, in 2021, capital imported into Nigeria stood at around $6.7 billion. And when you compare to 2020, that was around $9.7 billion. And we take the very high view and look at pre-COVID, what was the level? It discovered that it was around 18 to 24 billion COVID. And so it's not a very positive picture we are seeing at the moment. What is, like you mentioned, Ladi, as our Q2 capital imported into the country stood at $1.5 billion. Q1 was around 1.6. You put both of them together, you have around 3.1. And then you say, well, let's make the assumption that we continue at that pace. What do we have at the end of 2022? 6.2 compared to 6.7 in 2021. It's not a very pretty picture. And then when we talk about the report we're expecting tomorrow, if you take a clue from the monthly reports published by the CBN, because the capital importation is derived from the CBN based on interbank transactions, how they track it, and as well as some information from the customs. So based on that report, you put it together, we think that unless there's an update, capital importation should come in at around 1.17 billion for Q3 2022, approximately 1.2, which means that for the third quarter, we're seeing this capital decline. And the implication is that when you put all of these three together and sort of analyze and say, oh, at this current rate, what would the picture look like by the end of 2022? Then you're looking at a case where capital imported into the country for the full year is around 5.7 or best case $5.9 billion. This would imply that you have to go back to as far as 2016 to look at where annual capital imported into the country is this low. So we think, based on expectation, it's not very positive. And in terms of the breakdown, the utility of the report will be seen tomorrow will be how it aggregates that number and shows us where this project is coming from. But we suspect that it will likely be from the portfolio flow component.
All right, we'll definitely be looking out for that. But back to Q2 now. What would you say were the key factors that affected flows in Q2 2022?
Yeah, thank you very much. So the factors are affected in Q2 and the same that we think would drive this Q3 number. They are not particularly new. But to start with, from the global perspective, 2022, we saw synchronized tightening across the board, how central banks increased their policy rates to try to stave off rising inflation. In the US, for instance, rate has risen from near 0% to around currently around 4.25, 4.5% levels. And what impact that has on economies, emerging economies, and economies like Nigeria is that the tightening of global financing conditions leads capital owners to rethink how they allocate this capital. And there's usually what you call the flight to safety, and then they just look at the United States, for instance, which is a very important economy, and say, oh, their rates are at this level at the moment. Why keep your money in the emerging markets where their currency is being pressured? They are having a lot of shocks affecting them. So typically, they just tend to take their capital elsewhere. So I think Nigeria, as well as some other countries, experienced this in 2022. But when you come down to the economy, some of these problems are homegrown, and they are, like I said before, they are not really new. For instance, you look at our FX policy. It's one of the key concerns that investors are having, and whenever there is a global shock, one of the concerns is how will this affect the foreign exchange dynamics in the country, as well as policy direction. Look at policy that sort of impede the flow of capital to try and manage the situation, and the sort of unintended negative consequences it can have on investors' confidence. And then again, aside from that, the overall business climate in the country is something that investors are wary about. For instance, you have the situation like we're currently experiencing with the power outages, at the same time having capacity at the same time, and it's not a very good situation. Importantly, also, there's the consideration of the insecurity that has persisted in the country, something that affects business decision-making, affects how investors look at the economy. And I think the last one that is kind of important to also note is the pre-election uncertainties. In 2020, most of the outlook was around how would the run-up to the election be, how would the social economic situation look like, would it be calm? And thankfully, we have seen some bit of that so far. But we think as at that time, that was some of the major concerns.
All right. Talking about the capital market now, what effects do you see, in the long run and short term, if these factors still persist that shaped capital importation in 2022, that's Q2, how do you see this impacting the capital market?
Oh, yeah, thank you very much. So in terms of how the impact capital market, like the saying was that every cloud has silver lining. So I say that the performance of similar market, how that despite decline in growth participation was seen over the years. For instance, in 2022, as of November, participation was around 16% for foreign investors, as around 15% for September in the year before. For long term, this is while short term it seems to be insulated all of global stocks. So for long term, this will make it for long term. Also, we want the market so liquidity depth we are for it. When you look at a country like Nigeria, in terms of FH, is according to the World Bank, is currently it was at 0.6% in 2021. SSA around 3.
All right, Shago. Shago, so sorry. It seems your I can't really I can barely hear you at this point. It seems the volume is dropping, but maybe if you speak up a bit, maybe I could hear you better.
All right. How about now? Is it
okay? Yeah, sounds better. Yeah.
Yeah. Apologies. So, like I was saying, issues we have.
All right. Looks like it's still dropping. It's still dropping. Maybe we'll try this again.
Okay, no problem.
Okay.
Sorry about that.
Sounds great now. I can hear you now.
Sounds great.
Yeah.
Oh, okay. I've done away with the headphone. I think
fantastic. Yeah, let's do it like this.
Okay, awesome. So essentially what I was saying is that short term, we seem to have been able to see some, get some or observe positive outcomes in the equity market. Our equity market plus 20% year to date last year, the year before around 50%. And most of it was because we were insulated from global shocks. But long term, this is not very good. You want your capital market to get deeper in terms of liquidity, and there's a limit to which you can mobilize capital domestically. Some of it has to come externally. When you look at some of the underlying issues that is affecting capital importation into Nigeria, it tends to see how it affects the pricing of Nigerian assets and the perception that foreigners have or foreign investment have of our economy. So we think that these are not very good long that we should pursue, even though short term we've seen some positives from how the equity market performed. So long term, it will affect liquidity, it will affect perception, it will affect pricing of Nigerian assets.
All right, given the trends you expect to play out in 2023, but we're seeing, globally, inflation, seems to have peaked. Hopefully, with what we've seen in the Eurozone and the US, and we're seeing the Fed also looking at, slower pace of rate hikes, but we still have aggressive, rate hikes here in Nigeria. How do you see this impacting capital importation into Nigeria going forward?
Okay. So Nigeria, we think that it's quite a relief or it should be a relief for everyone if the current signals we are seeing in terms of inflation persist. How that in the UK, US, across Eurozone, even in Nigeria, we begin to see early signs that it could be the case that inflation is cooling off. And when that happens, policymakers will have the incentive to either slow down the pace of hiking or choose to hold rates, or in fact, they can even pivot at some point this year. And so what that will do for emerging market assets generally is that it will lead to capital flow reversals. Investors will become more risk on and try to push capital into these markets. For a country like a challenge we have is that some of this problem we have is down to our policies, down to not just the economic factors or the global factors, but how our policy we go about implementing them, how the policy also affects business decision and all of that. So we think that for Nigeria, we are quite optimistic. In fact, our projection is that for 2023, we expect capital importation to improve to around 7%. We think that the election will come with a bit of optimism. All the candidates for the election, they are pro-market, and that will bring some sort of comfort. But we think that there's more that needs to be done. We have to address issues like insecurity, I mentioned, infrastructure, and our policy in terms of even providing guidance to investors. They have to know that we are clear on the path and we are committed to that path rather than a flip-flop and unclear kind of implementation.
So I guess what you're saying is whoever wins, the election is pro-market and pro-business. Yes. Whoever. Okay, that's good news. But what are your, policy prescriptions now for the next CEO that takes over affairs in Nigeria to boost investor confidence into the country?
Okay, thank you. So in terms of policy choices we think that are paramount for the next president, we're happy about, we've seen the manifesto of the leading candidates. There are common themes of others on reform, subsidy removal, exchange rates, liberalizing more, privatizing, and all of that, giving the private sector more room in the economy. And we think that one of the key issues we have to address will have to be insecurity. And when we talk about FDI, one of the key considerations will be how safe the country is. We think that in the last couple of years, we've seen the spate of insecurity increase at an uncomfortable rate, and this is not good for business. So we think that one of the four most challenge that must be addressed will be trying to bring security and normalcy to the economy. We think on top of that, there has to be also infrastructure. We have to be focused on providing infrastructure to reduce cost of doing business in Nigeria, to improve the ease of doing business, reduce also all of the bureaucracies around setting up and running businesses, as well as trying to harmonize taxes where they have to be. Importantly, we think that the orientation we have to take going forward is that we have to shift away from FPI and deal more with FDI. FPI, called hot money, is somewhat like a quick win. Sometimes you just do one or two things, raise rate here, raise rate there, and if some other policies are in place, capital flows in, and investors like that because they can easily move in and out. They don't have to commit long term. But what you need to grow a country is actually that long-term commitment. And to have that, you have to take critical and beyond the surface reforms to really prove or show that you are ready to do business.
Right, fantastic. Well, we'll be looking out for that report for Q3 2022. That's supposed to come out tomorrow. When we get that, we'll see if there's an improvement from what we had in Q2 and the year-on-year performances. Thank you so much, Segun Adams, Research Analyst, AfriInvest Research and Consulting. Thank you.
Thank you for having me.
All right, so we'll take a break now. When we come back, we head on to the market to see what Anyete has for us. That's the moment to stay with us. Welcome back. All right, let's take a look at how your money performed yesterday. The local boss. We have Anyete now with the details. So I see it's red,
good morning, Ladi.
But not that red. Good morning.
Yes, another day of red.
Yeah.
I mentioned yesterday when we were talking about the morning after the MPC's interest rate hike, which was the fifth. I said that it wasn't as a result of, at least on the immediate, it wasn't as a result of the MPC's rate hike. It's actually due to profit taking, which is still continuing. So, but the impact, most likely we're going to see it in time to come, maybe a week and over maybe a couple of days after. So, but
because it is a problem for these companies listed on the exchange. Cost of credit going up, fifth time, and obviously from what we had in 2022, that's going to somehow play into how much credit they'll be getting in 2023. So we will expect some kind of impact.
Yeah, like it or not.
But this one we're seeing right now, who knows what?
well, of course, there's no ruling out that the monetary policy rate hike is going to have an impact on the equities market, whether on the upside or on the low side. But there's no ruling out that, but you can only keep that as a side dish for now.
Side dish?
Yes, a side dish.
Interesting.
So, all right, so let's go to the transactions for midweek trading session at the NGX. The NGX is another day of bloodletting, not much of hemorrhaging for the market. It was down by 7.03 billion naira, but we just approximated to just about 7 billion naira. Now, in terms of the decline on the all-share index, which is a measure of how all the stocks listed on the NGX perform. It was down by 0.02%, which is what you see there, but still within the 52,000 region, a little bit pullback. Year to date, we're still in the positive terrain. Still January. January is just about some couple of days into winding up, just about 5 days. But so far we at 2.63% year to date. Now, take a look at the sectoral performance. Sectoral performance, we saw the pullback by Zenith Bank, UBA to be precise. There was profit taking there, so as well as one of the tier 1 lenders. So that's why the banking counter was down by 0.34%. Consumer goods was up. We saw Unilever posting a very impressive fourth quarter earnings result. So that's rubbed on its own index, its own counter, the consumer goods counter. It was up by the same margin of the banking sector, but in the green side. But what we saw, why the market was down, was because of the profit taking on MTN Nigeria, Geregu. Geregu had made some gain, but then at some point made some pullback. So that's why the market was in the red. Now, take a look at the industrial goods counter as well as the oil and gas counter. They were unchanged. No movement on the price of Dangote cement, no movement on the price of Boa cement, as well as some other key components of those counters. Let's take a look at the activity chart. Activity chart, in terms of activity, the volume of activity was down, as you can see there, 34.30% for the volume. Value also in the red, 44.22%, while deals was down by more than 2.3% for that market. Now, we had the shares of, there was a positive market breadth. We had 21 gainers against 16 losers. So far, the market is still on the upside, but then we will be looking out for how the impact of the monetary policy rate hike 2 days ago announced by the Central Bank's Monetary Policy Committee, how it plays into the market, the capital market. So now let's move over to the smaller unlisted securities market. It's another downside for that market. It was down by more than 1%, 1.43% is what you see there. The index gradually dropping almost to the 600 points for that index, while the market cap has dropped all the way from the 1 trillion naira level, which it had attained sometime last year, from the beginning of last year, into 920.67 billion naira. That's the current level. Now let's take a look at the activity on that part. That part of the market, it made another pullback. Another pullback. The volume traded there declined by 34.3% there. So it was down. And then at the same time, we also saw the deals was up. Stocks traded, we had one gainer there. One gainer was Geofluids, while the two losers there were the shares of Friesland Campina and Central Securities Clearing System. So that's that for that market. Let's move over to the fixed income market, where we'll be talking about the impact 2 days after the Central Bank's Monetary Policy Committee interest rate hike. What impact did that have on the market, as well as the primary market auction, which was conducted yesterday for that market. But in terms of the bonds market, it was mixed, but at the same time, it was with a bullish tilt. We had, take a look at the board there, 18th of April 2037 paper had 6 deals at a value of 3.6 billion naira. Well, you can see all the rest, 10 billion for the 26th of April 2049 paper, as well as the 22nd of January 2026 paper, 5 billion, cumulative 22.98 billion naira. Let's move over to the Treasury bills market. It was also another mixed sentiment, but on the bullish side, we had only 2 instruments traded there, the 16th of March 2023 which had just 2 deals, as well as the 23rd of February later next month. So total number of deals there carried out was 4 at 3.2 billion naira. Now let's move over to the OMO market. The OMO market average yield there still remains unchanged. At the OMO market, it was unchanged at 2.9%. But for the money market, overnight lending rate expanded by 66 basis points to 10.8%. So that's it for that market. So now to give us more insight into the market, the primary market auction, let's talk to Caleb Alimi, who's a chief dealer at Providence Bank, to tell us more about the midweek transactions at the fixed income market. Thank you for joining us, Caleb.
Good morning, Aniti. Thank you for having me.
Yes, and I will also say Happy New Year. Now, can you talk us through?
Happy New Year.
Yeah, all right. Yeah. So can you talk us through into 2 days after the Central Bank's Monetary Policy Committee meeting, what impact did that have, as well as the primary market auction? And then we're slowly winding down the month of January. What are we to expect next week for the equities market when we cross into February, as well as the upcoming bond, FGM bond auction to be carried out next week on Monday?
Okay, let's take it from the MPR, the outcome of the MPR meet, of the MPC meeting, where the MPC hiked the MPR by 100 basis points, 17.5%. Most of the market expected about a 50 basis point hike. However, we saw a 100 basis point hike. We haven't seen that really translate into interest rates in the fixed income space, on the market space. That's largely been due to the system liquidity. As of yesterday, system liquidity opened at over ₦1 trillion, and that impacted significantly on the NTB auction. There was an NTB auction yesterday with around 220 billion on offer, but you'll be surprised to know that over 1 trillion was actually thrown at the auction. That also then led to, serious compression in the rates across the 91 days, 182 days, and 365-day paper. Seeing the largest compression around the 365-day paper, which shrank 252 basis points from its last stop rate of 7.3 to 0.78. Another interesting thing is to know that the auction was about 4 to 5 times oversubscribed, given that the DMO offered just about 220 billion, like I mentioned, over $1 trillion, was in all of that. And that has, sort of limited the impact of the hike in the MPR, where we're not seeing that direct correlation. Currently, there is a fear of CRR, and that is leading banks and other investors to just, pick up the securities that are available. And that's why we could see the one-year paper, which closed yesterday's auction at 4.78, trading somewhere around 3.5% this morning. We expect that will continue into next week, where, well, there is a bond auction next week. We can see that there could be a bit of tempered expectations, ordinarily given the borrowing program of the government for this year. We expect that, interest rates are going to spike, also just to follow suit what the MPA need. However, going into next week's bond auction, where there's a total of 360 billion on offer across maturities, we expect that interest rates are going to be slightly moderated just because of the liquidity in the system. However, that could also change if there is a sizable CRR, activity by the central bank tomorrow. Going into wrapping up the rest of the year, we expect markets to remain liquid, rates to remain slightly, moderate because of, like I said, ending the actions of the CBN. Going into next month, we expect that there will be less and less liquidity. We expect liquidity to continue, and perhaps we'll see that impact of the hike in MPR then begin to affect interest rates.
Okay, so now one more question before I let you go. With the current interest rates, the new interest rates at 17.5% and inflation at 24.34%, how are investors reacting to this? Just in 30 seconds, please.
Well, long-term investors are demanding higher rates, but short-term investors, don't have a lot of securities to face. Like I said, given where the one-year NTB closes, there's very little real return you can expect to have, right? And we expect that that interest rates will continue to, will probably stay around where it is, given the liquidity.
Okay.
So nothing much is going to.
Okay. Thank you so much for that analysis, Caleb. So that was giving us the analysis,
Welcome.
Caleb.
Thank you.
Thank you so much. So that was Caleb Alimi, Chief Dealer at Providence Bank, giving us an analysis of the fixed income market.
All right, so we'll see how the market plays out today.
I think
tomorrow,
I'm on the bullish side. I'm on the bullish side.
Bullish side. All right, fantastic. All right, now let's take a look at what's happening with other markets. Now we see Bitcoin there recovering from the pullback we saw yesterday. It had a correction below the 23,000 level, but it's back above that. Remained well near the 22,400 support zone, a low that was formed at 22,341. If you look at the sentiment in the market now, we see it's neutral. Deeper into neutral, 54 points. I mean, greed is loading up somewhere in there. Let's look at the market cap, $1.06 trillion, back deeper into this $1 trillion mark. It's up 3.14%. Volume traded up 8.64%. So we're seeing Bitcoin there getting some bullish sentiment back again. Let's bring in Rume Ofi now, financial market analyst. Hello, Rume.
Good morning, Larry. Good morning.
Good morning, Rume. And I see this market is rallying again. Is it because banking giant Goldman Sachs has ranked Bitcoin the best performing asset globally in 2022. How?
The truth is that the global leading investment bank is saying the truth. And if you focus very well, you notice that data from CoinMarketCap has actually said that $200 billion came into this market, despite what happened with FTX challenges and all of the things that have happened. This is very significant. I was privileged to take a look at that report. Bitcoin has actually outperformed other cryptocurrencies, pairs, and other major financial institutions and trading traditional market. This is because there's a lot of interest. Investors' appetite is increasing. And there's something I really like about all of this is that there's this metrics they use. It's called risk adjustment return, which is also known as Sharpe ratio. It is 3.1, which means that the market actually measures volatility, and it shows that when the numbers are higher, the ratio for it to be a better investment it becomes that. So Bitcoin has actually established itself as a better investment. And I usually used to tell a lot of people that this is not just about talking; it's about an emerging industry that we in Nigeria and other parts of Africa need to position ourselves aside just Bitcoin, just holding Bitcoin, allowing it to pump or allowing the value to appreciate. There are skills actually that are needed to be able to position ourselves better for this industry. And I think it is good that we all look towards that direction, not just about Bitcoin, but it's also very, very important that to note that Bitcoin is actually looking to break above 24,500 level. Let's just keep our fingers crossed.
Right, fingers crossed at this point. All right, we'll see if that happens. Thank you so much, Ruma Ofi, financial market analyst. Thank you.
Thank you very much, Ladi.
All right, so maybe that happens. If you see the price of Bitcoin this morning, $23,127, nearing that 24K, could break at some point, up 1.93%. Well, that's it for the market, and that's it for the show today. Thank you so much for watching. Don't forget you can join us at 1:30 for Business Incorporated for more updates and developments in the world of business. You can watch this again on our YouTube channel. Just flip over to YouTube, search for Channels Television. You can see all our productions. Thank you for watching. I'm Ladi Williams. Bye for now.